Hi, welcome back to Solution in YouTube channel. In today's video we will learn about Days Payable Outstanding, also called Payable Payment Period. Days Payable Outstanding is a financial ratio that indicates the average time, in days, that a company takes to pay its bills and invoices to its trade creditors, which may include suppliers, vendors, or financiers. The ratio is typically calculated on a quarterly or annual basis, and it indicates how well the company's cash outflows are being managed. A company with a higher value of days payable outstanding takes longer to pay its bills, which means that it can retain available funds for a longer duration, allowing the company an opportunity to use those funds in a better way to maximize the benefits. Companies having high days payable outstanding can use the available cash for short-term investments and to increase their working capital and free cash flow. However, higher values of days payable outstanding may not always be a positive for the business. If the company takes too long to pay its creditors, it risks jeopardizing its relations with the suppliers and creditors who may refuse to offer the trade credit in the future or may offer it on terms that may be less favorable to the company. The company may also be losing out on any discounts on timely payments, if available, and it may be paying more than necessary. This is the formula for calculating days payable outstanding. To manufacture a saleable product, a company needs raw material, utilities, and other resources. In terms of accounting practices, the accounts payable represents how much money the company owes to its suppliers or purchases made on credit. Additionally, there is a cost associated with manufacturing the saleable product, and it includes payment for utilities like electricity and employee wages. This is represented by cost of goods sold, which is defined as the cost of acquiring or manufacturing the products that a company sells during a period. Both of these figures represent cash outflows and are used in calculating days payable outstanding over a period of time. The number of days in the corresponding period is usually taken as 365 for a year. Days payable outstanding attempts to measure this average time cycle for outward payments and is calculated by taking the standard accounting figures into consideration over a specified period of time. Additionally, a company may need to balance its outflow tenure with that of the inflow. Imagine if a company allows a 90-day period for its customers to pay for the goods they purchase but has only a 30-day window to pay its suppliers and vendors. This mismatch will result in the company being prone to cash crunch frequently. Companies must strike a delicate balance with days payable outstanding. As a historical example, the leading retail corporation Walmart had accounts payable worth $49.1 billion and cost of goods sold worth $420.3 billion in year 2021. These figures are available in the annual financial statement and balance sheet of the company. Taking the number of days as 365 for annual calculation, the days payable outstanding for Walmart comes to 42.7 days. Similar calculations can be used for technology leader Microsoft, which had $2.8 billion as accounts payable and $41.3 billion as cost of goods sold, leading to a days payable outstanding value of 24.7 days. It indicates that during the fiscal year ending in 2021, Walmart paid its invoices around 43 days after receiving the bills, while Microsoft took around 25 days, on average, to pay its bills. But note that both Walmart and Microsoft are operating in different industry. So for comparison purposes you should consider a company within same industry. Let's take a detailed example. Assume a company had opening accounts payable of $2,400,000 and closing accounts payable of $3,100,000 in year 2010. The average of which will be $2,750,000. Similarly in year 2011, opening accounts payable of $3,100,000 and closing accounts payable of $3,400,000 in year 2010. The average of which will be $3,250,000. The cost of goods sold for both years are calculated by adding opening inventory to purchases and deducting the closing inventory. So the cost of goods sold are assumed to be $39 million and $32 million in year 2010 and 2011 respectively. Using the formula for days payable outstanding, you can see that in year 2010, company was paying its suppliers in 25.74 days, which increased to 37 days in the year 2011. It means, on average, the company is holding cash approximately 11 days longer in 2011 than in the year 2010. If you have understood the concept, give this video a like and subscribe for more lectures. If you don't understand anything related to this video, please ask us in comments.